Imagine a life free from the daily grind. No alarm clocks, no rush hour traffic, no boss looking over your shoulder. This is the promise of financial freedom, attainable through the power of dividends. Dividends represent a powerful tool for generating passive income. This essay will demystify dividends, empowering you to harness their potential. Dividends are a share of a company's profits distributed to its shareholders. These payments can provide a steady stream of passive income. The most common type of dividend is the cash dividend, a direct payment made by a company to its shareholders. Cash dividends offer a tangible way to benefit from your investments. While cash dividends are the most prevalent, there are other types of dividends that investors should be aware of. Understanding various types of dividends empowers you to make informed investment decisions. Dividend yield is a crucial metric that helps investors evaluate the income potential of a particular stock or investment. It represents the annual dividend payment per share as a percentage of the stock's current market price. Dividend yield represents the annual dividend payment per share expressed as a percentage of the stock's current market price. Understanding how dividend yields are calculated is essential for making informed investment decisions. Let's delve into a real-world example to solidify our understanding of dividend yields. This example illustrates the dynamic nature of dividend yields and how they respond to changes in a company's stock price. Several factors can influence dividend yields, including a company's industry and financial health. Understanding these factors is essential for investors seeking to build a well-rounded income portfolio. Dividend growth is the true holy grail of dividend investing. A company that consistently increases its dividend payouts over time offers the potential for compounding returns. Navigating the world of dividend yields requires a discerning eye and a strategic approach. By focusing on companies with sound fundamentals and a history of dividend growth, investors can position themselves for long-term financial success. Before embarking on any investment journey, it's crucial to establish a clear destination. Defining your financial freedom number will serve as your guiding star, motivating you to stay the course. Dividend investing offers an alternative path to financial independence, emphasizing generating passive income without selling your underlying investments. The dividend strategy empowers you to detach your income from active work, giving you the freedom to pursue your passions. Section 3. Calculating your required investment. To achieve financial independence, calculate your required investment by dividing your desired annual income by your estimated dividend yield. For example, $50,000 divided by 4% equals $1,250,000. Regularly review and adjust your calculations to stay on track. Section 4. Setting realistic dividend yield expectations. When calculating your required investment for dividend income, it's crucial to establish realistic dividend yield expectations. While chasing exceptionally high yields might seem tempting, it's essential to remember that higher yields often come with higher risks. Companies offering unsustainable dividend payouts might be forced to cut or reduce their dividends in the future, potentially jeopardizing your income stream. A prudent approach involves targeting a dividend yield that aligns with your risk tolerance and the overall market conditions. Historically, the average dividend yield for the S&P 500, a broad market index representing 500 large-cap U.S. companies, has hovered around 2 to 3%. However, focusing solely on the market average doesn't provide a complete picture. Individual stocks, particularly those of well-established companies with a history of consistent dividend payments and growth, might offer higher yields than the market average. Real estate investment trusts, or REITs, which are required to distribute a significant portion of their taxable income to shareholders as dividends, can also provide attractive yields. When setting your dividend yield expectations, consider diversifying your portfolio across various asset classes, industries, and companies to mitigate risk and enhance potential returns. Remember, it's not just about chasing the highest yield, but about finding a sustainable balance between income generation and capital preservation. Section 5. The power of compounding fueling your dividend growth. One of the most compelling aspects of dividend investing is the potential for compounding returns. When you reinvest your dividends back into your portfolio, you create a snowball effect that can significantly accelerate your progress toward financial freedom. Imagine receiving $1,000 in dividends from your portfolio. Instead of spending this income, you reinvest it back into your dividend-paying stocks. As these stocks continue to pay dividends, your dividend income increases, allowing you to reinvest even more in the next cycle. This continuous cycle of reinvestment and dividend growth creates a powerful compounding effect over time. As your dividends compound, your investment portfolio grows at an accelerated pace, potentially outpacing inflation and generating significant wealth over the long term. To maximize the power of compounding, consider enrolling in a dividend reinvestment plan, or DRIP, offered by many brokerage accounts. DRIPs automatically reinvest your dividends back into the underlying stocks, simplifying the process and allowing you to take advantage of even small dividend payments. By harnessing the power of compounding through dividend reinvestment, you create a virtuous cycle of growth that can supercharge your journey toward financial freedom. The allure of high yields, a slippery slope. In dividend investing, high yields can be tempting, but experienced investors know the risks. High yields often mask underlying issues. Chasing them can lead to financial disaster. Sustainable income is key. Prioritize stability and growth. Diversification, the cornerstone of dividend resilience. In the world of investing, diversification is not merely a strategy, it's a fundamental principle that underpins long-term success. This principle holds especially true in dividend investing, where building a resilient income stream requires spreading your risk across various asset classes, sectors, and individual companies. Imagine constructing a portfolio solely composed of dividend-paying stocks from a single industry, such as energy. While this sector might offer attractive yields, it's inherently exposed to the volatility of energy prices, geopolitical events, and regulatory changes. A sudden drop in oil prices or a shift towards renewable energy sources could significantly impact the profitability of energy companies, potentially leading to dividend cuts and a decline in your income stream. Diversification acts as a shock absorber, cushioning your portfolio from the inevitable ups and downs of the market. By investing in a mix of dividend-paying stocks across different sectors such as healthcare, consumer staples, technology, and real estate, you reduce the impact of any single sector's underperformance on your overall portfolio. Furthermore, consider diversifying geographically. Investing in international dividend-paying companies can provide exposure to different economies, currencies, and growth opportunities, further enhancing your portfolio's resilience and potential for long-term success. The tax factor unmasking hidden costs. Dividends offer passive income, but they're not tax-free. Taxes can significantly impact your returns. Understanding tax treatment is crucial. Dividend income is taxed differently than capital gains. Tax rates vary by income level and holding period. Qualified dividends are taxed at a lower rate. Non-qualified dividends are taxed as ordinary income. Use tax-advantaged accounts to minimize taxes, hold dividend-paying stocks in IRAs or 401ks, prioritize qualified dividends to lower taxes, hold investments long-term for lower tax rates. Section 4. Concentration risk, avoiding the single stock trap. Investing in a single, high-flying stock can be tempting, but it exposes you to significant concentration risk. A downturn in that company's fortunes could devastate your portfolio and derail your financial goals. Diversify your portfolio across numerous stocks and sectors. Avoid allocating more than 5 to 10% of your portfolio to a single stock. By spreading your risk, you create a buffer against market volatility. Section 5. The value of fundamental analysis, looking beyond the dividend. While a company's dividend history and yield are important factors to consider when building a dividend portfolio, they should not be the sole basis for your investment decisions. Relying solely on dividend metrics without delving deeper into a company's financial health and future prospects can lead to poor investment choices and disappointing returns. Imagine a company boasting an impressive track record of dividend payments and a seemingly attractive yield. However, upon closer examination of its financial statements, you discover that its earnings have been declining, its debt levels are rising, and its competitive position is weakening. These warning signs suggest that the company's ability to maintain its dividend payout might be at risk, despite its historical performance. Fundamental analysis involves scrutinizing a company's financial statements, assessing its management team, evaluating its competitive landscape, and understanding its long-term growth prospects. By conducting thorough research and looking beyond the dividend, you gain a more comprehensive understanding of a company's financial health and its ability to sustain its dividend payments over the long term. Remember, a company's dividend is only as good as its ability to generate profits and maintain a healthy financial position. By incorporating fundamental analysis into your investment process, you can make more informed decisions, identify companies with sustainable dividend payouts, and build a portfolio that can weather market storms and deliver long-term value. Section 1. The power of diversification. Building a resilient income stream. Imagine building a house on a single pillar. While that pillar might seem strong and sturdy at first glance, any weakness or instability in that single point of support could bring the entire structure crashing down. The same principle applies to building a dividend portfolio. Relying solely on a handful of dividend-paying stocks, no matter how reliable they might seem, exposes you to significant risk. Diversification acts as a safety net, spreading your risk across multiple investments to create a more resilient income stream. Just as a house with multiple pillars can withstand greater stress, a diversified dividend portfolio can weather market storms and continue generating income even if some holdings experience a downturn. Think of your portfolio as a garden. Instead of planting all your seeds in one small plot, diversification encourages you to cultivate a variety of plants with different needs and growth cycles. This approach ensures that your garden thrives even if one type of plant struggles due to weather conditions or pests. In the context of dividend investing, diversification involves investing in stocks across different sectors, industries, and geographies. This strategy reduces the impact of any single company's underperformance on your overall portfolio, creating a more stable and predictable income stream. Section 2. Identifying dividend champions criteria for selection. Not all dividend-paying stocks are created equal. Look for companies with a history of dividend growth, known as dividend aristocrats. Analyze financial health, focusing on profitability and cash flow. Consider management's approach to capital allocation. Evaluate competitive landscape and long-term growth prospects. Section 3. Dollar cost averaging, navigating market fluctuations. The stock market is inherently unpredictable, characterized by periods of both exuberance and fear. Trying to time the market perfectly, buying low and selling high, is a fool's errand that often leads to missed opportunities and costly mistakes. Dollar cost averaging offers a more disciplined and effective approach to building a dividend portfolio, especially during times of market volatility. This strategy involves investing a fixed amount of money at regular intervals, regardless of market fluctuations. When the market is down, your fixed investment buys more shares at a lower price. Conversely, when the market is up, your investment buys fewer shares at a higher price. Over time, dollar-cost averaging smooths out the ups and downs of the market, potentially lowering your average cost per share and enhancing your long-term returns. This approach removes the emotional element from investing, allowing you to stay the course and build your portfolio consistently, regardless of market sentiment. Imagine investing $500 every month into a dividend-paying stock. During months when the stock price dips, your $500 buys more shares, increasing your potential for future dividend income. During months when the stock price rises, your $500 buys fewer shares, but you benefit from the price appreciation of your existing holdings. Dividend reinvestment, often referred to as a DRIP, is a powerful tool that amplifies the growth potential of your dividend portfolio. This strategy involves automatically reinvesting your dividend payments back into the underlying stocks, purchasing additional shares, and accelerating the compounding effect of your investments. Imagine receiving $100 in dividends from your portfolio. Instead of spending this income, a DRIP automatically uses those funds to purchase additional shares of the dividend-paying stocks you already own. As those additional shares generate their own dividends, your dividend income grows, allowing you to reinvest even more in the next cycle. This continuous cycle of reinvestment and dividend growth creates a snowball effect, compounding your returns over time. As your dividends compound, your investment portfolio grows at an accelerated pace, potentially outpacing inflation and generating significant wealth over the long term. Many brokerage accounts offer DRIPs as a convenient and cost-effective way to reinvest your dividends. By enrolling in a DRIP, you automate the compounding process, ensuring that your dividends are consistently put to work for you, even if you're busy with other aspects of your life. Building a diversified dividend portfolio capable of generating significant passive income doesn't happen overnight. It requires patience, discipline, and a long-term perspective. The stock market is inherently volatile, and even the most well-constructed portfolios will experience periods of decline. Focus on the long game and stay true to your strategy to weather these storms. Avoid the temptation to chase short-term gains or panic sell during market downturns. Remember, you're investing in companies, not just ticker symbols. Focus on the fundamentals and trust the market to reward strong companies. View market downturns as opportunities to acquire additional shares of high-quality companies at discounted prices. Just as a patient shopper waits for a sale, a disciplined investor sees market dips as a chance to enhance their portfolio. Embrace the power of compounding. The longer you allow your dividends to compound, the more significant their impact on your portfolio's growth. Stay the course, reinvest your dividends, and let time work its magic. Building a diversified dividend portfolio is a journey, not a destination. Embrace the process, stay informed, and never stop learning. By combining a sound investment strategy with patience, discipline, and a long-term perspective, you can create a portfolio capable of generating significant passive income, paving the way for a more secure and fulfilling financial future. As we've explored throughout this essay, building a life of financial freedom fueled by dividends is an achievable goal for anyone willing to embrace the journey. It's not about overnight riches or get-rich-quick schemes. It's about making informed decisions, staying disciplined, and letting the power of compounding work its magic over time. Remember that investing in dividend-paying stocks is not about simply chasing the highest yields. It's about finding companies with solid fundamentals, a history of dividend growth, and a commitment to rewarding their shareholders. It's about building a diversified portfolio that can withstand market fluctuations and generate a consistent income stream for years to come. The path to financial freedom through dividends is a marathon, not a sprint. There will be ups and downs along the way, periods of market volatility and uncertainty, but by staying focused on your long-term goals, tuning out the noise, and remaining committed to your investment strategy, you can navigate these challenges and emerge stronger on the other side. The journey towards financial freedom begins with a single step. Start by defining your financial goals, calculating your income needs, and understanding your risk tolerance. Educate yourself about dividend investing, research different companies and sectors, and seek guidance from trusted financial professionals if needed. Remember that the most important investment you can make is in yourself. The more you learn about investing, the more confident and empowered you'll become in making decisions that align with your financial aspirations. Embrace the power of patience and discipline. Building a dividend portfolio capable of generating significant passive income takes time. Avoid the urge to chase quick profits or make impulsive decisions based on short-term market movements. Stay the course, reinvest your dividends, and allow the magic of compounding to work its magic. The journey towards financial freedom is within your reach. Start today, stay committed, and watch as your dividends pave the way to a more secure and fulfilling financial future.